Hello everyone, good morning and welcome to this edition of The Market. I'm Avan Dabash. With me is Nikunj Dalmia as well as Anisha Jain. And yes, the last week of June has brought with it the onset of the monsoon, not just in Mumbai but in Delhi as well at the same time. And this is for the first time in over 60 years. Those are the visuals playing out for you. The monsoon hitting the metro cities on the weekend, and there's a rain alert, of course, now today as well, with the weather department saying that there's an orange alert for Mumbai and the surrounding regions, and they've also issued a yellow alert for New Delhi as it's going to be light to moderate rainfall that's expected over the next 48 hours. So that is something that the markets as well will be monitoring. But that aside, of course, with the early rain arrival, as we will get our umbrellas and our raincoats, etc., all out, it's been nothing short of a pretty volatile week for the equity markets. We've had 5 consecutive weeks for the frontline indices of gains, and looks like we put the brakes to that just last week with the Nifty snapping that gaining streak. For the broader markets, in fact, it's been nothing short of a pretty stellar and a long winning streak, 12 straight gaining streaks that we've seen weeks on the trot for the broader end of the market. But that has been snapped and the breadth is at a 20-month high. So Nikunj, question is that now, of course, monsoon is something that we are going to monitor here in Mumbai. But with the fact that we've snapped that gaining streak, what does it mean?
See, for me, the yellow light has started. It's not the red light. For me, the yellow light has started. I think we moved from...
Not the IMD's alert. You're talking about the red light.
Yeah, the real red light for the market. That's an orange alert. Yeah. This is the yellow light from a market standpoint. For me, that actually has started. And I'll tell you why that has started. Because globally, things are turning. Markets are suddenly worried about interest rates hike at a global level. And FIs, they've started selling, and some of the rank outperformers in this rally, whether it's a Tata Motors or a Paytm or a Zomato, some of the outperforming hero stocks of this summer rally 2023, they're hitting a pause button. I expect the following. I think India will outperform in this global market volatility. That is absolutely certain. You could see profit booking and mild profit booking in some of the haloed stocks. And in the near term, I will not be surprised that if the market could really struggle a bit in order to regain some form. So one of those patches of the market where you do not want to commit more, you do not want to cut your longs, but there is no harm in taking some chips off the table if you've really hit a gold rush in some of the mid and the small cap stocks. We are going through that phase of the market where the market perhaps could see some time-wise and a mild price-wise correction.
Okay, in that phase of the market where it's not a bad time to maybe take some chips off the table, you don't have to exit out. It's not getting very a bit of a red zone, but yes, yellow is something that we are highlighting at this point of time. And that yellow was visible over the last week as well. As you pointed out, the Nifty was down 0.8%, but if you look at it in context of what's happening globally, we were much better because the likes of Dow, etc. were down almost 2%. For the week, of course, it's going to be about expiry, so that is an important thing to watch out for. And in context of that, these are the support and the resistance level that we are watching out for at this point of time. 18,770 is a bit of a resistance. So fair to say, Nikunj, that those all-time high levels are probably not going to happen this week as well, because for now, at least this morning, the cues are not very positive. Let's see where we go from here.
All-time high is now academic. You missed it by 2 points. You made an all-time high on the Sensex. The Bank Nifty made an all-time high. With the exception of mid-cap index, if you frankly look at the market setup, I don't think that all-time high of the ring of all-time high on the Nifty really matters. Let's look at the support levels and the important levels for the Nifty. And that's the support point for the Nifty. I will not be surprised that at higher levels if the market really runs into some kind of a resistance. Because FIs, they've started selling at higher levels, and selectively more than short selling, I guess profit booking has started. Now, the month to date, the FI figure is still constructive. But the year to date FI number is actually negative. So while a whole lot of money has not come on a month to date basis, but given where the block deals are, how action has started in the IPO market, how OFS have started, block deals have started, the market orientation clearly seems to be indicating that suddenly there is more supply and there is less demand. The equilibrium of strong FI flows and DI activity, which was the driving force for the market, is that reversing or is that getting challenged? I would say that is getting challenged. It is not reversing, and that is the reason why I think one is better off right now erring on the side of caution rather than committing any fresh flows. And look at the size of IPOs which have started. These are small IPOs, but if the IPO gold rush is returning, you got to be a bit careful. Also, some stocks which are off from the recent high. We don't talk about it, Anisha, but some of these stocks are off from the recent high. Paytm is down 6-7%. Zomato is down 5%. Tata Motor DVR is 5-6%. Indian Hotel is down 6%. We not realized it. We're talking about all-time high, but a self-correction in some of the high flyers has already started.
Yeah, because these stocks had run up also quite a bit, and we kept on talking about how these stocks are close to the record high levels, but nonetheless, we are seeing some amount of profit booking there and some sort of caution coming into the market at this point of time, Amma.
Yes, indeed. And it is pretty interesting as well to look at that block deal data that Nikunj was alluding to. The fact that according to the exchanges and reports, the month of June has seen over 42,000 crore rupees. The month of May as well has been around 15,000 crore, but it's significantly jumped up higher. So that is really the trade setup, the market setup, and Nikunj's take. But it's interesting, Nikunj, because you've also got that mega ET Now exclusive, lots that happened behind the scenes in the latest edition of CEO at Work. Why don't you tell us more about it?
Oh yeah, I mean, it was an honor to have Mr. Sanjeev Puri on the show. And just imagine when Mr. Puri took over, the dynamics for ITC were different.
Yeah.
The tobacco business had plateaued. The hotel business and the paper business was going through a cyclical downturn. And you did have a cyclicality in the entire paper business, and FMCG business did not reach that scale and size. So ET Now, well, we were in Punjab at Kapurthala in one of the biggest manufacturing or one of the biggest FMCG manufacturing setup of India, and we spoke about what is the plan for demerger, how exactly things would be scaling up in the FMCG business, and the whole experience of understanding the dynamics of supply chain and what kind of capacity ITC is creating because they're getting future ready, I think was an extraordinary. So this is a must watch, and this is something which I think clearly could be called as a mega exclusive.
Oh well, yes, the secret sauce behind
our non-cigarette revenues are about 2/3, and non-cigarette EBITDA is also now 28%. It is becoming significant, and all these are growing faster than the rate at which the overall company grows. And today, 80% of our capital employed is actually in the non-cigarette sector. So that's where the investment is. So from our perspective, it's about providing industry leading performance in each one of the segments. That is the objective. It is about leadership in every segment, not merely because of size, also on account of product or the services. We want leadership. So where we are already leaders, the idea is, can we progress further? Where we are not leaders, we need to become leaders. In some of the newer businesses, some categories, we may not be leaders. The idea is to become leaders there. So that's the way we look at it. But because the opportunity and our investments are aligned towards the newer segments, naturally over time, I think they will grow faster. They will occupy a bigger salience in our whole kitty.
Grit, patience, and perseverance. These are three things which define the personality of Sanjeev Puri. When Mr. Puri took over as the chairman of ITC, timing was rather challenging, but things are different now. For ITC, all businesses are firing full cylinders. The stock is at an all-time high. So what has been the secret sauce? So that brings ET Now to one of India's biggest mega factory, and it is indeed an honor and a pleasure to have the man himself, Mr. Sanjeev Puri, chairman of ITC. So the mantra to come to an ITC factory is that skip your breakfast and then come.
Absolutely, yes.
Okay, so that's the mega exclusive that you do not want to miss. You can catch it on a TV tomorrow morning or, of course, all the social media handles. So do watch out for that interesting conversation. But what about the day today and how is it likely to pan out? We have our technical experts joining us to talk to us about just that. Naresh Mirani as well as Kunal Bothra as always join us on the show. Kunal, you go first. We were just discussing whether those live highs are happening this week or not. Week of expiry, the monsoon shower here and a lot of stock specific news flow which is lined up this week.
See, I think generally during the expiry week, we don't see the index. Rather, we see the index going into a bit of a consolidation or the positions being shifted as well as churned. So my sense is that possibly this, the next couple of days, as well as a short week, the probability of the index coming back towards the new highs could be a bit less as compared to what was maybe last week or so. Now, the last week's selling, especially the last couple of days of selling for the indices, has dented the short-term prospects of the indices. And my belief is that possibly over the next couple of days we could get into a bit of a repair mode, but a mild consolidation. 18,600 still remains to be a strong support for the index, even though we've tested this level twice in the last week. But I still believe that till the time we hold on to that 18,600 mark, the bias would remain bullish. But it's just that the pace of the rally, which was still intact for the indices, that could take a bit of a backseat. There's no major change in terms of the open interest positions for the Nifty as well as for the bank Nifty. So hopefully, if that doesn't get replicated, for the next series rollovers, then I believe that maybe at the start of the fresh series of the July expiries, where we can expect the new highs coming back into the index.
Naresh, would you say that for a trader, it's no longer green light, it's perhaps yellow light now? Time to air some caution?
Yeah, so we'll put it in yellow light because when we keep getting, say, resistance around the same prices and not able to break it, there could be some bit of a pause or a correction. Whether this comes out to be a correction which goes below 18,600 and all the way to 18,200, that is still in a question mark as of now. So once we start breaking 18,600, that is where we say, okay, we are going back to 18,200 and making a much deeper consolidation before we cross 18,900. So for now, the bias is positive because the only way one could have rode this rally from the bottoms is by having this bias till the time prices do not change, you continue to have a bullish view. Because we've seen pauses come at 17,400, 17,800, 18,200 and so on and so forth. So as of now, 18,900 was the zone for a pause, which was the previous high. 18,600 is the interim support. Till the time we are above that, we keep the bias to be positive and wait for it to break to change the view.
So close and yet so far when it comes at least to those all-time highs, but our chart is talking about the important and critical levels to watch out for this expiry week. That's the SGX Nifty indicating a pretty quiet start around the 18,700 mark. Let's also find out those top trading recommendations. And Kunal, what's looking good on the charts?
So I'll go with individual names. The first one is a buy on Cummins. That stock looks attractive. I think closed at 1840. 45 odd mark, looks attractive for a target of 1900. The stock is confirming a breakout in the short-term chart, specifically on the hourly time frame. So targets of 1900, stop loss could be kept at 1818. And the second would be a buy on Trent, and this stock has apparently done exceptionally well. On the daily charts, it's formed a flag pattern, and the stock is confirmed a breakout above the flag pattern, breaking past above the 1700 level. So would aim for a target of 1780 on Trent, stop loss at 1700.
Okay, Cummins as well as Trent, and yes, for Trent, Zudio has been one space that has been doing quite well for them, the value format that you have, Zudio, so that's been talked about as the next lever for growth for that company. But in the meantime, Naresh, what are your top ideas?
So first is a buy on Bharti Airtel. The stock has come close to an all-time high. A classical cup and handle formation, 860 was the high before this. We saw a spike on MSCI day, but if we remove out that spike, 860 is the breakout point. We went closer to that on Friday. Setting up for a breakout, the stock has been sideways or out of radar for quite some time. And good momentum move in the last two sessions when the markets were not in great momentum. Stop loss at 840 and a target price of 920 in the short term. Second is a buy on NTPC, a defensive stock, but the stock is 1% away from an all-time high. The stock gave a breakout and has been holding on about 80-82 mark and has recovered back sharply on Friday as well. So once it sustains 189, 190 levels, could see a quick move towards 205, a stop loss to be kept at 182.
Okay, there you have it. Those are the top recommendations that our chartists are flagging off. But the big question still remains when we're going to hit that crucial 1 lakh mark on the Sensex. We've spoken to some top market veterans on the channel, the likes of Atul Suri, Vijay Kedia, as well as Sameer Arora. Hear out what they have to say.
I haven't done the maths, but why not? Really, why not? It's just basic compounding. It's going to get there, yeah. You know, having been in the market for 30 years, I saw the Sensex at around 1,000. So that's like what you're talking about is a 50, 55, 60% move. So I'd see that there's no reason.
Because I don't invest in any Nifty stock or any Sensex stocks and all. So when I talk about Sensex, that means I'm talking indirectly, I'm talking about my portfolio. So whether index doubles from here or not, that is a issue. But I expect that this mid caps where I am investing, in the general mid cap category, good stocks should double or triple in next 2-3 years time. And so far index is concerned, I think that index is a counting of 21 is happening index 21,000, 42,000, 63,000. And I think that next stop should be 84,000 in 2 years from now. And of course, 100,000 is just a destination, I think, and miles to go for index.
So for that, my simple thumb rule is compound at about 13-14% and see whether 1.14 to the power of 5 into 66,000, does it become 1 lakh or no? So plus minus, it would be there. Because broadly speaking, if I look at it over any reasonably longer period, the returns have been in this range. So, you know, it doesn't need too much of rocket science. That's why I tweet saying you want 2 lakhs, you just extend the number of years. Because broadly speaking, this number doesn't come only from the fact that historically this has been the range over last, I saw it over 3 or 4 periods, which is 5-7 years. And then I think I did 14 odd years and then some 20 years and then my own my career, which is about 26-27 years, and broadly over every period it is in this range. But this range is not just coming by looking at historical numbers, but by the fact that Indian GDP in rupee terms grows about 11-12%, and then you can add 1 or 2 more percent for the fact that corporate sector might be doing better than the rest of the economy, or you might be doing it from an equity risk premium point of view, that equity returns are normally 5 to 6% more than the fixed income 10-year type return of the same country's government bond. These are all worldwide things. And also broadly, we feel that for a large part of the corporate sector, the earnings growth for normal, once they become a little distinct, in the range of 12, 13, 10, 15%. And then some companies grow at 20, 30% for some periods of time. So from all angles, it looks that is the thing. So you just multiply and see, but I would think it would reach somewhere there.
Okay, let's discuss some stocks here. And one stock which I think is worth revisiting, which in a sense has been the star outperformer, was Piramal Enterprise, largely because of the Shriram Finance deal. Nuresh, this stock has been in some kind of an hibernation. One news flow and the stock really took a giant leap forward. Is Piramal out of that hibernation now?
So, say the target price for the current move is done because it made a big spike. But are we looking at a major turnaround? Yes, possibly. So if you look at the price action before this move, it always had a problem around the 920 mark. That is where after that demerger and the listing, 920 was a problem. Went about 920 only for a day, and we flipped back again in the last 2 sessions. So if we had to look at the gap up on that day was around 790 to 890, 900 levels. We filled that up. So at 840 to 860 is where you want to actually be looking at it as a dip buy, where the announcement is done and you are getting a retest and a fade off of the move. So at 840 to 860 would be a buy, and next time I would expect it to sustain about 920 and go towards the 1050 mark. So positive on the stock, because the price action as well as volumes in those 2 days of a gap up was very strong. It was almost a 5x, 10x volume jump up. So would be looking at a buy today on a dip to 840, 860.
Now, stocks which have reversed, well, Tata Motors, for example, or Tata Motor DVR, 300 plus has become sub 300. Tata Motor also from the recent, 3-month chart, of course, is great. But if you look at the 5-day change or compare the stock from the 52-week high, selling in a sense was quite sharpish. 583 has now become 560. So Tata Motor from the recent high down 5%, Indian Hotel down 6, Zomato down 5, Paytm down 6. Now Kunal, these are the performing stocks. Suddenly they're down. 5, 6, 5 could become 10, 10 could become 15. Has the tide turned for a Zomato, Paytm, Tata Motor, Indian Hotels?
Not really, Nikunj, if you ask me, because I would still believe that we are into a phase. In fact, we pointed out this last week that we are into a phase where most of the stocks which have done reasonably well, there is a definite bout of profit booking into these names, and the money is now getting churned into the large cap names. So, for example, last week we saw the likes of HDFC Bank, etc. Managing to outperform most of the other peers in the banking names, just as an example. So I believe that there could largely be a case where profits are being booked because of the fact that many of these stocks have either come back into their overbought nature of indicators, or these stocks have diverged significantly higher from their long-term averages, the 200-day moving average. So there's bound to be some sort of a mean reversion. But I still believe that because of the rally, which was a bit more structured for these stocks, not exponential, that the price correction may not be very steep. So I think maybe a 5% on a basket, and depending on the beta, maybe a 10% correction for these high beta stocks could be at best a correction which one can anticipate. And if there is in fact such a kind of an opportunity where these stocks say come back to their respective 50-day moving averages or 20-day moving averages, as the case may be, that could actually be a good contra buying opportunity back again.
What do you think, Naresh? Some of these real heroes of the summer rally of 2023, Paytm, Zomato, even for that matter Tata Motor, they're taking it slightly easy.
So after a move of 30-40%, pause is almost necessary for a longer term structure to be positive. You don't want to see a spike off and a cool down where the stock doesn't make a comeback for a long time. So if you look at a Zomato, a Paytm or Tata Motors, they could have made up a good 30% move over the last 2 months, even more in some cases. Now, if I were to look at Zomato, it started from 50, 55, went up closer to 80 levels. Now, the next pause ideally should be at 65, 68. Now, that's a zone where you want to buy if it comes down to. Overall, the structure has changed. That is the more important part, wherein the long-term structure, which was down post the breakdown in 2021-22, has changed. And going forward, we are making a constructive move wherein slowly and steadily these stocks do well. So I want to buy on a sharper dip, a correction of 15% plus from the top. Same is the case with the Paytm, which has gone up in a one way. For it, a similar pause point comes around 800 to 770 levels. So that's a price point. If it comes, you want to be buying. Tata Motors, if you look at the longer term structure, it becomes much more interesting. Because if we go back to 2014-15, the stock had topped out around 600 levels. Now we came very close to it and have started correcting. Now 600 becomes a major point of the last 6-7 years. So if you have to break 600 mark, it will require a lot more time-wise correction before we make that move. So for now, 530 to 540 is a zone I would be looking out for Tata Motors. So that is the price point you want to buy, or wait for this consolidation to get over. So I think we are getting into a consolidation in the structural moves, not a major top in the making.
Okay, so that's the take coming in as far as Tata Motors is concerned. A bit toppish there, but shifting focus to the stocks which will be in focus today. Z Entertainment, of course, there's that big hearing which is lined up, so we're waiting out for that. And then separately, of course, ICICI Securities is also being focused because there are talks that the company might get delisted. Kunal, your take on a couple of these counters? Anything that chart patterns, read very interesting?
So I think for Z Entertainment, there's nothing exciting because, the stock has been a disappointment. When you look at it on the yearly charts, the stock has been making lower highs almost on a successive basis over the last 1 to 2 years. And even on the short-term basis, the stock which had resistance around 240, then the resistance scaled down towards 220. The recent rally, if I'm not wrong, for Z was around this 200 odd mark, and the stock failed to cross over those levels convincingly. So when you see a resistance falling down with a very sharp kind of a pace, that generally is an indication that the stock has not yet formed a bottom, and it could be in for more selling pressure in every bout of rally or a bounce for itself. So that's what I would probably put in for Z, that the stock is still weak in terms of the chart structure. ICICI Securities could be interesting because the stock, in fact, in the last 2 months recovered quite smartly. I think, if I'm not wrong, from 420 levels, the stock has jumped back towards 500, 520 odd mark. So it's a decent 20-25% recovery for ICICI Securities. The way in which the stock has rallied also is a very slow, gradual and a steady pace. It's confirmed a breakout of its 200-day moving average. The top was formed almost a week odd back for ICICI Securities from 550 levels, and the stock has already corrected some 5-6% from those points. So even with respect to price correction, that's also been anticipated for ICICI Securities. So I think that becomes an interesting buy at current levels.
All right, those are some of your movers and shakers on the charts. Tell you what, we'll take a very quick break. Be right back as we get you stocks on the editor's radar and stocks in news and lots more.
Welcome back. Well, let's shift focus to the action in the markets today. And from the primary markets, the Idea Forge IPO will open for subscription. My colleague Sharad is joining us with the details as to what does the business do, how do the valuations stack up, and what kind of interest are we seeing from the markets right now. Sharad?
Well, yes, in focus we are having drone manufacturing company Idea Forge. Their IPO issue has opened today with a total size coming roughly 567 crore rupees and the price band ranging between 638 to 672 rupees. Now there will be a fresh issue of roughly 240 crore rupees and the post-market implied market cap would be roughly 2800 crore rupees. Now they have raised roughly 255 crore rupees from anchor investors, which big names such as Nomura and Goldman Sachs also coming into the list. Apart from this, looking at the company, they are having roughly 50% market share in the Indian unmanned aircraft systems, and they were of course ranked 7th in the dual use category drone, and the drones are having their usages across defense as well as in civil purposes. Now the product portfolio consists of hardware, software as well as embedded solutions. Interestingly, Infosys is holding 4.35% stake in the company as well, and they are not actually exiting in this IPO. Apart from this, roughly you could say 70% of revenue comes from the defense segment, with their order book coming in at roughly 185 crore rupees. Now looking at the financials, the company has actually turned profitable over the last 2 financial years for FY22 and FY23. Apart from this, looking at its peer set when it comes to valuation on a 12-month forward basis on a calculated manner, we have taken Idea Forge's PE ratio to come in at almost 28 times. Now this is as we compare with MTA Tech, Data Patterns and Astra Microwave, it's on the lower side. Now apart from the valuation, there are certain triggers also for the Indian drone industry which would be in focus, and the Indian drone market is expected to grow by 80% CAGR from 2022 to 2027, and roughly the market size will go up from $43 million to roughly $812 million. And over the last week or so, there was an important announcement coming from the government as DGFT has liberalized the policy for export of drones as well as UAVs for civilian end users.
Thanks very much, Sharad, for giving us those details. Yes, a lot of activity as well within the primary markets, but let's move on and listen into the management of Idea Forge and what they had to say.
So we are looking at productizing our current portfolio to next levels, and we are also looking to venture into different markets internationally as well as we are venturing into a different size and shape of drones. Today we cater to about 50 kilometers set of market range, the kilometers endurance range, and we would be venturing into tactical and middle mile range of products going ahead.
All right, moving away from that, lots more stocks that will be in the spotlight today. Management meets, analyst days, and that's going to keep Dabur and Apollo Tyres in the spotlight. We've got Vinny here with the highlights. And Vinny, what exactly did the managements have to say in these meets?
So let's start with Apollo Tyres. The management met with a few analysts, and in terms of demand trends and revenue, seems like a bit of subduedness is coming in, because what the management spoke is that they believe that the India revenue growth is likely to taper off to mid to high single digit in FY24. They're seeing a moderation in terms of OEM and replacement segment and lower exports as well. What they're highlighting is that the revenue far from Europe in FY24 is to be flattish, is what they believe as well, and raw material cost is expected to remain from flat to a bit higher on a quarter-on-quarter basis, at least for Q1 FY24. Other than that, obviously on EBITDA basis, they say that Indian EBITDA margins are likely to come in at 14 to 15%, and Europe is likely to be at 16 to 17%. Positive commentary in terms of they're expecting an improvement coming in the return on capital employed. In FY23, it's at around 10%. By FY26, they're expecting it to be at 12 to 15% range. Capex plans of 1,100 crores is what they're expecting in FY24, and the Andhra Pradesh plant facility, they believe that could improve in terms of quality control, better productivity, as well as cost control measures as well. Moving on, let's talk about Dabur. We have positive commentary coming in here, at least in terms of the rural segment. They're saying that sequentially consumption is improving in the rural markets, that has picked up pace. They expect normalization in the second half of FY24. Food inflation, yes, that's a bit of a pinch coming in, especially on the rural belt in the HPC segment. Unseasonal rains, that has cut the demand for juices as well. And healthcare, they see a bit of a moderation in terms of momentum over there. But high Rabi output and increase in MSP Kharif season, that could improve the consumer sentiment, as well as EBITDA margins. They expect that to see an improvement going forward as well, especially in the second half of the year. They expect it to be in the range of 18 to 20%. And they believe the new CEO will be someone who will be driving 20% growth for the Badshah acquisition as well.
Thanks, Vinny, for that. So that was about Dabur, but it's an interview that you cannot miss. ET now gets exclusive access to ITC's massive manufacturing plant in Kapurthala, Punjab, where the chairman and managing director Sanjeev Puri shares their growth roadmap and explains why FMCG will be the next big growth driver for the company.
We believe that this will be certainly be a lot more value accretive with passage of time. We have seen in the last medium term itself that not only has the today our size is 1.5x of pre-COVID. Over a medium term, our margins have expanded by 770 basis points. ROCE has gone up by 1340 points. And we are not there. We are not done as yet. The journey continues. We believe that we will expand margins by, our aspiration is about 100 basis points every year. So there's a lot of opportunity there, and we have laid a strong foundation with our trademarks, with our innovation capability, with our digital capability, with our distribution highway. We have not really tapped the potential of exports. We've just started in the short term to put the distribution apparatus in place.
So some of your brands can actually be exported, the one which are made in India.
We're already exported to 60 countries. But the headroom to grow is huge because it's early days.
So just to bring that point again on the FMCG business, you are in the top quartile, certainly top 3 in terms of top line. But in terms of profits, you are not there. In terms of margins, you are not there. When do you think you will be able to reach the top quartile from an industry standpoint? 3 years, 5 years, or more than 5 years?
So let me give you a little perspective on this. Our FMCG business includes a lot of gestating costs for facilities like this, which are designed for scalability, incubation of newer brands. There are certain older brands that are big, and because the older brands are able to make more and more surplus, they're able to offset the gestating cost here. So we are improving, and we will improve by 100 basis points every year. And then on the cost side, also we are pressing the accelerator high. One is, of course, naturally with economies of scale and scope we will gain. The other is, I gave you this example of this facility itself, how we are optimizing logistics, how we are delayering operations, how we are integrating not only logistics but back end, and then digital. Digital is becoming a very effective tool to optimize our operations, remove costs in facilities, in logistics, and in sales. And in sales because it leads us to better effectiveness. Just between last year and this year, our sales effectiveness has improved by 17% because of deployment of multiple digital technologies. So there are many things that we are working on, and we will...
The pieces are all coming together.
Yes.
Okay, before we head to understand what are the stocks on editor's radar, let's get your fundamental opinion coming in from Harinder Kumar of Elara Securities, which is the stock that he likes.
hydrogen is a game of scale. At the moment, only two large conglomerates have, put their hat in the ring, which is Reliance and Adani's, who have gone out and said that we're going to bring it at sub $2 and we're going to play the entire ecosystem. And there are other groups who have come and had a conversation on that. But as far as our analysis goes, these two large conglomerates are going to lead the way because they have an integrated logistics play. They have energy as the primary business, and they want to play the entire ecosystem. Beyond that, hydrogen, NTPC has also spoken about, but it's going to be a large players game. If you're asking in terms of clean energy, private sector, good name, I would say Tata Power. I think it's a phenomenal characteristics of a company which has ESG components, which has growth, and now which has multiple avenues in terms of charging stations, EPC for solar, a lot of embedded value in subsidiaries or, the opportunity to unlock value as well.
Okay, so those were some of the power sector plays. But let's welcome on board Amnish Agarwal, the head of research at Prabhudas Lilladher as well. Amnish, I just wanted to begin by asking you about ITC. I'm not sure if you heard the conversation or snippets of conversation that Nikunj had, but they're talking about how FMCG is going to be a big lever going forward.
Yeah, good morning. So, you see, I agree with that view because if you look at, say, past few years also, whether it has been a situation of slowdown or not, ITC's FMCG business has been growing in good double digits. And given the fact that some of the businesses have scale and ITC has been consistently entering the new lines of businesses, I think ITC's your FMCG business has got a long road ahead for growth.
ITC, but let's get a move on and put the spotlight on stocks on the editor's radar today, and we'll be discussing ICICI Securities and Natco Pharma. Let's begin by talking about ICICI Securities, and of course this is a stock in news. The board is going to meet at the on the 29th of this month to consider a delisting, and interesting given that ICICI Bank, the parent company, has about a 75% stake, and given its performance since its IPO, Nikunj.
This is a bit of a surprise because normally when stock prices are down, companies, they consider a buyback. They don't consider a delisting. Yeah. ICICI Securities went public largely because at that point in time, which is 5 years ago, ICICI Bank needed capital. But I think the reverse is at play, which is that they don't need capital. They've recently got approvals to increase their stake in ICICI Lombard, the general insurance business, and now they're looking at, they are proposing that they want to go ahead with the delisting of ICICI Securities. ICICI Securities as a stock has done precious little ever since it went public. Yeah. Even though we've seen, exactly, even though we've seen a huge change in the way how the number of demat accounts and what's happening to the mutual fund industry, ICICI Securities in a sense has not really been a grand market performer. In last 5 years from the IPO price, the returns really have been flat for ICICI Securities. One. Second, what would be interesting here is that when the stock is at a relatively all-time low or it's been flat and has given precious little performance, will their delisting offer be successful? And if they have to really delist when the stock has done nothing in the last 5 years, the question which needs to be asked is that will they come at a premium? If they will come at a very smart premium, I would say that it makes sense to tender the stock because this space is getting extremely competitive. But if the proposed price is not at a lucrative premium, then it makes sense to really hold on to that stock per se.
Okay, that's the view coming in on ICICI Securities. This is certainly going to be a newsmaker. Natco Pharma then, and the performance has been anything but, given the fact that the company has said that there's been an improved base for their business outlook, and off late, what a tear.
The stock went through a massive amount of re-rating, Avan, and that's largely because of what happened to the pharma space and the kind of product COVID portfolio Natco Pharma had. Then came the realization that what drugs they had to offer, that in a sense were not really having effect on that entire COVID cycle per se. Thankfully, COVID came down and they had to do a lot of inventory loss. But now markets are recognizing that there's strength in the balance sheet, there is cash in the balance sheet. Some of the product portfolios which they represent right now, they in a sense are also recovering from this price slump per se. Natco has an history that they are an innovator company. Every 2-3 years, they've been able to find one drug where in a sense could be called as a wonder drug for them. So that entire COVID re-rating became derating, and now business is normalizing. And when things are normalizing, looking at the balance sheet, looking at the fact that they are an R&D focused company, nobody owns it, nobody likes it, it makes sense to perhaps be a contra buyer in some of these niche companies, especially which are from the pharma space.
A contra buyer in Natco Pharma. There you have it, Anisha. Stocks on the editor's radar.
In fact, let me take it up from there. What's your view, Amnish, about Natco Pharma and the other underdogs per se from the pharma space?
You see, as we don't have coverage on Natco Pharma, but pharma space, I would say we are cautious at the present moment because the sector has not given consistent returns in the past. Within the sector, I think your Sun Pharma in the large caps and Torrent Pharma and JB Chemicals in the mid caps are the stocks which you like.
Okay, so those are some select strategies coming for you from the pharma space. But Naresh, what's your view as far as the entire real estate pack is concerned? Godrej Properties was in news over the weekend because they've acquired some more land, and then the rest of the real estate names were at least in an uptrend till a week or two ago.
So the uptrend is still intact. We've just seen some bit of a pause in these names after the sharp move. So the structure is still positive. DLF looks the most interesting one because the stock has come out of a multi-year breakout. Say the stock broke out over 400 to 430 levels, went up to 500 plus, and now it has faded off over the last 1 week towards 470, 480 mark. I would expect it to hold the 460, 440 mark. A dip closer to that zones would be a buying opportunity, wherein again the next time it goes above 500 and even higher, that is the view. So DLF is the first one. Second is looking at Prestige, which has given a breakout and is holding on. So these are the names, and say even a Brigade looks interesting. So DLF would be the top pick on dips in the real estate sector. And overall, the sector has the move it has made in April, May, June is generally an indication of a longer term uptrend starting possibly across the sector. So you want to be buying into this dip.
Okay, buy into the dips when it comes to the real estate sector. But Kunal, your take on a couple of these other news-based companies today. Apollo Tyres, of course, on account of that analyst meet that they had, the company reiterating their FY26 outlooks, but saying that in the near term, it's volatility which is going to be the name of the game for FY25 and FY24. The other one I want to talk about is Landmark Cars. I'm not sure if you have enough history on that one, but that stock too saw quite a bit of buying from marquee names.
Well, Apollo Tyres is interesting. I'll start off with that, Nisha, because it's been a classical stock. I was looking at the charts for Apollo Tyres. I think last quarter results when the stock was almost at 360, 370 levels. And from there, it just moved on from strength to strength. The stock has scaled past about the long-term averages. In fact, the last time, I remember that the stock had actually fallen below the 200 DMA, was almost like a year back for the stock. And that itself tells you the kind of strength the built-up the stock has seen over the last 1.5 odd year in terms of price recovery. So I think even at 410, 415 levels, if there is a marginal correction for Apollo Tyres, I would still believe that that's a good dip to buy into. For Landmark Cars, I would wait out for a confirmation, because even after Friday's strong up move, the stock somehow is taking resistance at the 725, 730 odd mark. So there were two previous attempts towards the breakout 725, 730 mark, but the stock failed to break out of those levels. We are currently at 717 mark, which means possibly another 15 rupees higher is where the test would come out of a resistance for Landmark Cars. So I would wait out for a confirmation about 730 levels, and if the stock actually closes about those points, we can start to expect that this consolidation is over for Landmark Cars and the stock could start to get trending.
Okay, so Apollo Tyres and Landmark Cars, that was a discussion on these two counters. But let's get your fundamental opinion now. This one is coming in from Dipan Mehta and why he likes Praj Industries.
We like this entire capital goods space, and two companies which come to mind which are quality players over there. One is Praj Industries, which of course is pursuing the ethanol opportunity, and second is VA Tech Webag, that's been also moving up, scaling to new highs. We all know the importance of water. I think it is front and central with every agency, state, central, as well as private sector. And VA Tech Webag is a quality player in water projects. They have an international footprint as well. Both the valuations, I think, compared to the business dynamics are reasonable, and they're sitting on multi-year order book positions, which we like. So I think there's good earnings visibility as well. But again, I think, these stocks have run up. One must, be a bit careful and do their own due diligence before investing in them.
Okay, let's discuss some more stocks with our guests on the show. Insurance is one space which is seeing a bit of a bounce back. Of course, HDFC Life has been leading that rally. But Amnish, your take as far as the entire insurance space is concerned, and if yes, what are the top bets?
Obviously, insurance is, I would say, one of the most interesting segments if you look at in the long term. And if you look at the stocks in particular, I think over the last 2 to 3 years, the insurance stocks have actually underperformed, whether it is life insurance or whether it is general insurance companies. So as far as I think if you look at in the long term, I think both life as well as general insurance companies, they hold a lot of scope for a consistent and steady returns. Now, looking at particularly life insurance space, I think among the listed inverts, HDFC Life continues to look good. Maybe today there is some news action due to which it can correct a little bit, and followed by SBI Life. As far as your non-life is concerned, I think we have got two prominent stocks. One is your ICICI Lombard, and another is Star Health. I think given the incidence of, you can say, the mediclaims, which is, you can say, less in India, and now this entire segment is catching up, I think in the long term, investors have got a lot of, you can say, scope to make high returns from both the segments, that is both life as well as non-life insurance. However, I think one will have to take a long-term view because the insurance companies per se, they are not very cheap in India.
Nuresh, has ICICI Bank topped out and has HDFC Bank bottomed out? They both are moving quite opposite now.
I don't think so. It has topped out. It's actually taking a pause. Say, ideally in a top out case, it should have fallen much more sharply. So it was making a range of 930 to 960. It broke below 930, and as the stock has gone nowhere for the last 4 or 5 days. So struggling around the tops rather than topping out. So waiting for the time whenever it crosses 940 would be a trigger that the trend has changed. HDFC Bank, on the other hand, has actually made a good move over the last 3-4 sessions. Holding on to that 1550, 1580 support zones and bouncing back. But the big struggle lies at that 1700, 1730 mark, which was the top when the merger got announced, and over the last 1 year as well. So HDFC Bank has finally shown some bit of a relative outperformance in the last 3 sessions, but too early to say whether it can cross 1700, 1730.
Now that same question, has ICICI Bank topped out, HDFC Bank bottomed out?
Well, HDFC Bank seems to have bottomed out, but I'm not sure whether ICICI Bank has topped out or not, Nikunj. I think, in this month, or rather in this series, is where ICICI Bank has underperformed most of the other peers, immediate peers, or even the smaller peers in terms of market cap. But I believe that when a large cap names gets into a 30, 40, 50 point correction or a time-wise correction, it's actually considered to be that possibly the stock is getting ready for a bigger up move whenever that breakout happens for the stock price, because where the sector does exceptionally well, large cap stocks take a bit of a time-wise correction. It's either on the back of some expected news flow or maybe some sort of a churn which is playing out within the sector. But once that part plays out is where we expect the stock to break out. So we'll have to be patient enough to wait out for ICICI Bank coming back about the 950, 955 mark, and that could be a strong breakout point for ICICI Bank. But yes, HDFC Bank seems to have definitely formed a short-term bottom, and I would not be surprised that the stock actually scales past about the new highs of 1725, I think 1725, 30 levels for HDFC Bank.
Amnish, what's your view on this entire defense space? And when I say defense space, I'll be specific here. Let's say BEL and HAL. These are companies which in a sense are going to be the biggest beneficiary of what is happening in the defense stroke aviation space.
Obviously, we like the defense space because India has underinvested in defense, maybe not last 5-7 years, maybe for at least the past couple of decades. So defense offers a very good opportunity given the kind of, you can say, long borders we have, given the fact that we are, you can say, some of our neighbors, I think they are large countries with very strong, you can say, defense equipment in their hands. So I think both the stocks, if you ask me, they are good, particularly if you look at, say, Bharat Electronics. Bharat Electronics offers you an opportunity to play you can say, the broad-based growth, because it caters to Air Force, it caters to Army, it caters to Navy, and the kind of electronic warfare equipment that Bharat Electronics makes, I think these are all futuristic products. And as we go along, I think the demand for these products is only going to increase from here. However, if you look at the entire defense pack, The P multiples of Bharat Electronics, I think they are perhaps the highest because the stock got listed maybe say 25, 30 years back. It's a seasoned stock. It has given returns to the, you can say, investors in the past. And so now it's quite, I would say, mature, and there is no big element of surprise which is going to come in terms of PE rating or something. Now, when it comes to Hindustan Aeronautics, I think another very good company. However, if you look at past 5 to 7 years, the growth has not been much because in some of these, you can say companies which are into aircrafts, which are into say submarines or frigate, the business usually tends to be lumpy. That is one. The second is here the capacity limitations also, you can say, play a big role. Now, what has happened with HAL, particularly in the last couple of years in particular, that the stock which was trading at say less than say maybe say 9, 10 kind of P multiple. So the P multiples have got massively derated and the stock will maybe say 4, 5x from the bottom. Now, incrementally from here on, I think the P multiple expansion will come at a slower pace. But having said that, the recent, you can say, visit our PM to US and the fact that these guys will now get your G engines for the new Tejas aircraft, so that is definitely positive for this company. However, one thing is re-rating and one is your secular growth. Given the fact that the business which say an HAL is having or maybe some of the other defense stocks, so they are usually lumpy. I think the P multiple re-rating might happen, might stop after a while, and then post that we will have very secular returns. But having said that, in the medium to long term, the stock looks good, and till the time the thrust of the government on the, you can say, upgradation of the defense forces, equipment as a thing remains at the center of activity.
Got some more details, and we were wondering in the morning that why ICICI Bank is looking at delisting their subsidiary of ISEC. Now, ISEC as a stock, frankly, in last 5 years, given that how competitive the landscape has become, what is happening to the entire brokerage space per se, commission structure, Zerodha has created a zero moment there. ICICI Securities or ISEC has not really been a massive wealth creator. From the IPO price versus the volatility in the stock versus where it is, it may be up from the 52-week low, but frankly, it's been a heck of a volatile stock. Now, when ICICI Bank decided to take ISEC public, that time they were in need of capital. They needed a lot of tier 1 capital. The stock price of ICICI Bank after that Chanda Kochar issue was trading at a multi-year low. And it made sense for them to perhaps raise capital via diluting the stake in ICICI Bank. So they decided to list ICICI Securities, a cash-making subsidiary. But now they're looking at reverse. And what we've learned, this is an ETNAM exclusive, that on 29th of June, rather than an absolute delisting, it really could be a share swap. In this case, what we understand, again source-based, the current investors or shareholders of ICICI Securities may get shares of ICICI Bank. And my colleague Ankur Mishra has got some details. And Ankur, first let's understand that why are they looking at delisting it, and if they're looking at delisting it, why are they looking at a share swap?
Yes, in general terms, when a delisting happens, the expectation of shareholder is that they are going to get cash. But this time, if we see details of the delisting notification which has been received on exchanges, it says that Rule 37 of Securities and Exchange Board of India delisting norms, which clearly means that the approval which the bank has got is for swapping of shares, meaning the shareholders will get shares of ICICI Bank, and the announcement of details will happen on 29th when the actual board meeting is happening, and how many shares of ICICI Bank will get, the shareholders of ICICI Securities will get. But for now, one thing is clear, that shareholders are not getting the cash in lieu of the shares which they are holding right now.
All right, Ankur, thanks a lot for that. Again, this is completely source-based story. Would you understand that they are looking at delisting? In the delisting, the existing shareholders of ICICI Securities will get additional shares of ICICI Bank. That's a share swap. 75% of the company is currently held by ICICI Bank already. Amish, let's discuss this news. ICICI Securities, when it went public, it in a sense, was the first of the big subsidiaries of ICICI Bank. That time they needed cash. They needed tier 1 capital. But now it's the other way around.
Yeah, Nikunj, if you look at last 5 years, the industry has changed a lot. It's not only the question of ICICI Bank, you can say, not having the capital requirements now, but it is also to do with the state of the industry. As you also said rightly, that the industry has become highly competitive. And ICICI Securities, for example, if you look at the various, you can say, segments of this company, they are into iBanking, they are into institutional business, they are into retail, and they are into, you can say, primary dealership. Now, particularly if you look at retail, it has become highly competitive, so is the institutional segment, and the investment banking, I believe, has been doing good when the IPO rush has been there in the last 2 to 3 years. So having said that, I think with 75% stake with the parent company, and actually ICICI Bank is not at a loss at all, because the current price is not very different from the IPO price. So now if any share swap ratio happens, I think the ICICI Bank has nothing to lose. They will only gain. And for ICICI Securities shareholders also, they are getting a share of pie in a much more, I would say, secular business, because broking and all these activities which ICICI Securities is doing, they are highly volatile, because in a good year, your profitability growth will be very high. But then during the lean years, you might be at the receiving end, and at the same time, the entire dynamics of the industry are changing. So I think it's a very interesting move, and it is actually contrary to what has been the trend over the past many years, whereas whereby you can say many banks, or you can say companies of that sort which are having the broking arms, they have been trying to list. So I think it also shows the kind of pressure which the industry is currently going through.
So where do you see ICICI Securities stock moving?
It's very difficult to say, because if it would have been a simple plain delisting exercise, then usually the expectation is that the shareholders will end up getting, say, maybe 30-40% premium. Okay, so they will get cash in their hand, and so in anticipation of that also, there is a renewed activity in the stock in the markets. But if it is something like a share swap, I don't think it is going to have significant impact on the stock price, because it imbibes some sort of an uncertainty, and everything depends upon what is going to be the share swap ratio. If the share swap ratio is favorable for the ICICI Securities shareholders, then the stock might make I would say, a bit of move from here on. But I would keep my fingers crossed and see what sort of a swap ratio is announced finally by the company.
Amnish, what's the outlook when it comes to the entire auto space, given the fact that we are seeing that domestic two-wheeler recovery? Also, when it comes to something like Bajaj Auto, the Bajaj Triumph is a fairly interesting and important catalyst for the company. How do you see the players within the two-wheeler space in specific?
The two-wheelers have been a bit on the receiving end in the last couple of years, and one of the major reasons has been the slowdown in the rural demand. The numbers in, I think, particularly the month of May, they have been pretty good for the two-wheelers or bikes in particular, because it shows some sort of uptick happening in the rural demand per se. So I would say the two-wheelers, they have some steam, because from the low base there, the demand can go up, and it is one segment where today the volumes are still significantly lower than what it used to be, say, 2 to 3 years back. So that gives some sort of, you can say, headroom for growth for these companies. But having said that, two-wheelers is one space where the impact of EV is also the highest. So that is why I think we have been, I would say, cautiously optimistic on two-wheelers, because it is going to be a very competitive space. Now, whether it is Bajaj, whether it is, I think, Hero, they are all entering the, you can say, 350cc above segments. And I think that is one segment which has been growing very well over the past couple of years in terms of even slowdown. But the mass segment is one, you can say, the bike between 100 to 150cc, where the maximum amount of pressure is there. Now, if the rural demand revives, I think in the next 2 to 3 quarters, one can see good growth to come for the two-wheeler companies. But having said that, I think given the state of monsoon so far, which has been, I think, below normal so far, one will have to wait and watch how you can say, the monsoon plays out, what is the impact of El Nino and all. But definitely, having said that, if there is no jitters given by monsoon and all, then all the two-wheeler companies have got decent scope.
Let's look at ISEC stock. It should be up. Needless to say, it should be up. If you are a shareholder of ICICI Securities, suddenly you may get shares of ICICI Bank. That's what we understand. Completely source-based information. Locked up 20%. Thank you very much. 675. public, not that ICICI Securities needs a lot of cash. It went public when ICICI Bank needed a lot of capital because of the write-downs they had to do, largely because of the economic downturn and after that Chanda Kochar episode. Now what we understand is that on 29th there could be a share swap. But meanwhile the market reaction I think is immediate. Let's look at ICICI Bank, which owns 75% in ICICI Securities, and where that stock is, I don't think it's going to move the needle significantly for ICICI Bank per se, because for ICICI Bank it's about the banking business and it's what's happening to their banking book rather than the subsidiaries. Because for a bank, if you're diluting, it may not really hurt them a lot. But for ICICI Securities, if you're a shareholder there, well, this is like a golden ticket that you're getting an out of jail card to get out of a business where the competitive landscape has only increased. And let's look at some other brokerage stocks. I mean, the only one which I can think immediately would be Angel, or even Angel, which is into discount broking. Motilal Oswal Securities, which is into AMC insurance as well as brokerage. So Angel 1, it's not going to change today, but in last 1 year, Angel 1 has come down. In last 1 year, the stock price of Motilal Oswal Securities has suffered. So this space in a sense is getting very, very competitive, something what we've discussed. From the 52-week low it may change, but otherwise in general from last 1 year per se, Motilal Oswal is down. Angel went through this gut-wrenching fall and now seems to be stabilizing. Amnish, so leave us with your best stock idea. Where do you think in next 24 to next 36 months, 30-40% upside possibly could happen? And I'll keep the market cap criteria open. Mid cap, large cap, small cap, you could choose.
Okay, if you're asking me, say, for the next couple of years, kind of, I think, horizon, one space we have been very optimistic about is capital goods. And I think among the frontline capital goods companies, I think the twin pack of ABB and Siemens, I think both the companies they are doing quite well. So they are in the center of whether it is, you can say, energy transition, digitizations, data centers. So this entire space looks very interesting, but particularly, I think over the next couple of years, Siemens and ABB, both these stocks looks very interesting to us.
Outlook, I mean, we were discussing as well earlier on the show how there are some select stocks as well that have come off from the highs. But what's your outlook in terms of Paytm, Zomato, new age tech companies and the investment rationale here?
Yes, it's for me.
Yes, Amnish, your outlook on new age tech?
Okay. So, if you look at new age tech companies, what has happened in the last couple of years, they have first of all undergone considerable correction from the highs we saw earlier. The second is that the business models are maturing. These companies have also realized that the times can be tough and you just can't continue burning for the rest of your life. The third aspect is that these new age tech companies, when they got listed, a lot of their valuations were related to what was happening in the US, particularly in case of the valuation of the tech stocks. If you look at the top 10 to 20 companies in the US tech space, they have seen considerable rally in the last 6 months, and some of the stocks have actually moved up by, say, anywhere between 50 to 80% from the bottom. So it is not only the fundamentals of the, you can say, the domestic listed tech companies which is showing in the stock prices, but also some uptick in the, you can say, the tech stock prices in the US, which is the largest market for such stocks. So in the long term, I think some of these stocks will stabilize, their business model will mature, and over the next 5 to 7 years, they can generate good amount of profitability and return for the shareholders. However, if you look at, say, the next couple of years, I think it is going to be a severe test case that how these companies adjust to the, you can say, ever-changing situation, how these companies become profitable and what sort of profitability they assume. Because let us take the case of any industry. In the long term, you can't continue valuing anything on basis of EV by sales, or you can say the market cap to, you can say, GMV sales or something of that sort. So I think in the long term, profitability is going to be the metrics, and I think that is where some of these companies have now started focusing, and there is a reasonable hope that some of these companies will turn profitable, maybe say over the next couple of years.
Okay, let's see when these companies do turn profitable. Thank you, Amnish, for joining us today with that quick take, but getting you the latest updates from across the globe as well. And in the latest on the cash-strapped carrier Go First, creditors have approved an interim financing of 425 crore rupees aimed at reviving the airlines. Board of Central Bank of India, Bank of Baroda and ITBI Bank yet to seek board approvals to sanction the said financing. Meantime, EdTech major Byju's promises investors that it will file the financial results for FY22 by September this year. They briefed as many as 75 shareholders over the weekend. Sources also suggest that results for the year ended March 2023 will come in by December this year itself. Meantime, across the globe, the Wagner troops have reportedly moved away from the southern city of Rostov-on-Don. The move comes in less than 24 hours after attempting a rebellion. According to the Russian state media, the Wagner chief will be moving towards Belarus. The charges against his troops will be dropped. U.S. Secretary of State Antony Blinken has said that an attempted armed mutiny in Russia shows real cracks in President Vladimir Putin's authority.
Meantime, over 1,500 cab drivers have written to Delhi's Transport Minister over the motor vehicle aggregator scheme. In the petition, the drivers have said higher cost of electric vehicles have been seen compared to other vehicles. They want a scheme and an easy loan option to be launched to balance the cost of making a shift to EVs much smoother. Meantime, the Union Home Minister Amit Shah has communicated with the Assam Chief Minister Himanta Biswa Sharma, assuring him of all possible help from the centre for the flood-stricken state. The situation has continued to remain grim over the weekend, with nearly 5 lakh people impacted by the deluge across as many as 9 districts. The only silver lining being that water levels have started receding as indicated by officials.